Imagine standing at the threshold of a market so tense, so imbalanced, that one false move sends shockwaves around the world. Today, you'll hear the truth. The silver market is at that threshold. What unfolds in the next 5 months could be historic, unless one pivotal event derails the script. Silver occupies a rare and powerful position in the global economic landscape because it operates on two critical axes simultaneously: monetary store of value and industrial necessity. This duality is not just a curiosity, it's a structural force that makes silver particularly sensitive to both macroeconomic shifts and sectoral transformations. As such, when supply chains tighten and macro conditions shift, silver does not simply react, it amplifies. One of the most defining characteristics of silver today is the persistent structural deficit that has now entered its seventh consecutive year. This isn't just noise or a blip in the system, it's a signal. The imbalance between how much silver is being mined and how much is being consumed is no longer theoretical. Physical inventories across major exchanges and vaults are visibly declining. Miners aren't bringing new supply online at the rate the world is demanding it, not because they don't want to, but because geological and economic constraints are becoming more pronounced. Capital investment into new mines remains muted after years of underinvestment following the last commodity supercycle. Regulatory, environmental, and political factors only add friction to the already slow-moving mining sector. At the same time, industrial demand is scaling rapidly. The green energy transition, particularly solar power, has become a non-negotiable priority for both developed and emerging economies. Silver, with its unparalleled electrical conductivity, is indispensable in solar panels. As governments double down on their climate pledges, demand from this sector alone is reaching new records annually. Add to that the explosion in electric vehicles, 5G infrastructure, and medical applications, and you start to see how silver is no longer just a marginal industrial input. It's a foundational material for the new global economy. But the industrial surge is only half of the story. On the monetary side, silver remains a crucial hedge in a world plagued by fiscal irresponsibility, elevated geopolitical risk, and decaying faith in fiat currencies. When investors seek safety, silver tends to follow gold upward, but with more volatility, and therefore more opportunity. What distinguishes this moment is that both roles, industrial and monetary, are aligning rather than diverging. Rarely in history do you find a commodity whose monetary premium is rising at the same time as its industrial utility is exploding. This creates a kind of feedback loop. As investors recognize the tightness of the physical market, they begin to shift allocations, which in turn stresses the available supply even further. Traded products tied to silver begin to experience inflows. Coin and bar demand from retail investors stretches mints and dealers. Refiners, already squeezed by limited raw supply, struggle to keep up. That tightness gets priced in first gradually, then suddenly. It's important to understand that unlike purely industrial metals like copper or aluminum, silver doesn't respond to inventory cycles alone. It responds to sentiment cycles as well, and sentiment around silver is building quietly but steadily. This is not about the short-term headlines or the noise around spot prices. It's about the underlying mechanics of a market where demand is growing from two different ends of the spectrum, while supply continues to contract or, at best, stagnate. What makes this even more precarious is that the market is relatively small. It doesn't take massive capital flows to move it significantly. That means the moment a large institutional player decides to reweight a portion of their portfolio towards silver, either for industrial tailwinds or monetary hedging, the effect is outsized. In essence, silver is not just another asset to be traded. It's a barometer of both our economic fragility and technological ambitions. And when the forces of scarcity collide with accelerating demand across both of its core roles, the outcome is rarely gentle. It's sharp, it's violent, and it usually catches those who weren't paying attention completely off guard. We're entering a period where the convergence of geopolitics, inflation, and monetary instability isn't just shaping the macro environment. It's reshaping the investment landscape entirely. These aren't isolated forces acting independently. They're deeply interconnected feedback loops, and understanding their interplay is essential for anticipating what comes next, especially in markets like silver, where sensitivity to these shifts is magnified. Take geopolitics. The global order is fragmenting. Alliances are weakening. Supply chains are being reconfigured, not for efficiency, but for security and strategic resilience. Trade wars are becoming the norm rather than the exception. From the Red Sea to the Taiwan Strait to Eastern Europe, strategic choke points are under threat. This kind of instability doesn't just drive fear, it redirects capital. Investors move away from paper assets linked to specific sovereign risks and into hard assets with intrinsic value. Silver, which offers both monetary insurance and industrial utility, becomes increasingly attractive in a world where trust is eroding between nations. Then there's inflation, which is no longer transitory, it's embedded. Structural inflation is taking root due to demographic shifts, deglobalization, labor realignments, and energy transitions. Central banks have been caught in a paradox. To control inflation, they must raise rates, but doing so risks breaking fragile debt-laden economies. Most are choosing the path of least resistance, accepting higher inflation as a reality while managing expectations. But inflation erodes the value of fiat currencies, and when the purchasing power of money declines, the demand for tangible, finite stores of value rises. Silver doesn't just preserve purchasing power, it has utility beyond its role as a hedge, giving it an edge in inflationary regimes that are driven by both cost, push, and demand, pull factors. The third variable is the U.S. dollar, which has been weaponized, stretched, and tested in ways that have created ripple effects across every other asset class. Its role as the global reserve currency, once unshakable, is now openly challenged, not just rhetorically, but through realignment of trade settlement structures, reserve allocations, and bilateral currency agreements. Countries are diversifying out of the dollar, not in panic, but in preparation. As trust in the dollar's long-term stability declines, the relative attractiveness of alternatives, especially those not controlled by any single government, rises. Silver becomes part of that conversation, not just for individuals, but for sovereigns and institutions seeking strategic insulation from dollar volatility. When you layer these forces together, what you get is not just uncertainty. You get directional pressure. You get capital that begins to reorient toward scarcity, toward value preservation, and toward versatility. You get market behavior that becomes more reactive to signals from the geopolitical and inflationary landscape. A central bank comment, a surprise CPI reading, a shipping lane blockade, each one has an amplified effect in this type of environment. Silver's volatility becomes its advantage. It moves fast. It reflects these shifts in real time. And because it sits at the intersection of risk aversion and industrial necessity, it captures capital flows that are hedging against the future and betting on it. What's critical now is not to think in linear terms. We're not in a world where past patterns will simply repeat. We're in a world of regime change. The rules are shifting. The anchors that investors once relied on, low inflation, geopolitical stability, dollar supremacy, are no longer fixed. They're drifting, and as they drift, portfolios that are still tethered to the old assumptions will find themselves exposed. In this kind of world, you don't wait for clarity. You position ahead of the curve. And that means recognizing where the imbalances are building and where the repricing is likely to happen the fastest. Silver stands right at that fulcrum point. When you're looking at the way markets behave over long periods, what you're really doing is studying human nature expressed through price. Patterns repeat not because charts have memory, but because people do. That's why technical setups matter not in isolation, but as reflections of deeper psychological, economic, and structural realities. Right now, the setup in silver is pointing to something significant. You don't need to be a technician to see it, but you do need to think in terms of cycles, not moments. What we're seeing is the maturation of a secular bull market, one that has been forming quietly beneath the noise. It's not linear, and it's certainly not smooth, but the trajectory is becoming more apparent. The 2011 peak, the subsequent bear market, the multi-year basing structure, all of it has laid the groundwork for a potential breakout. This is a classic cup and handle pattern forming on a multi-decade chart, something that doesn't show up often, but when it does, it commands attention. What it signals is consolidation followed by expansion, compression followed by release, and that's precisely the phase we're entering. Markets don't break out of these long-term structures casually. It takes a shift in fundamentals, a shift in psychology, and a shift in flows. We're beginning to see all three. Positioning is light. Institutional exposure remains minimal relative to other asset classes. Sentiment is still lukewarm. That's not a negative, it's fuel. When the breakout happens, the reallocation process begins. Capital has to move. Portfolios have to adjust. Momentum strategies pile in, and the price moves farther and faster than most expect. Now layer in the gold-silver ratio. Historically, this ratio has been a powerful indicator of relative value between two of the oldest monetary metals. When it stretches too far in one direction, it tends to mean revert, and right now it's stretched. We're hovering around levels that have historically preceded aggressive moves in silver. In previous cycles, a ratio above 80 signaled that silver was undervalued relative to gold. At 90 and above, it's not just undervaluation, it's distortion, and distortions don't last. This isn't about guessing which metal is better. It's about recognizing imbalance. Gold has had its run. It's captured the inflation hedge narrative. It's absorbed much of the fear-based capital. Silver, on the other hand, has lagged. That gap doesn't represent weakness. It represents opportunity. When the ratio begins to compress, it doesn't mean gold falls. It means silver plays catch-up. And catch-up in a thin, under-owned market is explosive. There's also a mechanical element to this. Many large allocators don't just buy silver because they're bullish. They buy silver to rebalance their gold-silver exposure. When gold outperforms for too long, it triggers those rebalancing flows. ETFs, sovereign wealth funds, commodity funds, they all follow models that are built on relative strength and mean reversion. Once the signal flips, they act. And when they act, liquidity matters. Silver, being the smaller market, reacts more violently. This is how bull legs begin, not with everyone already on board, but with structural imbalances quietly building until the pressure can't be contained. The chart tells that story. The gold-silver ratio confirms it, and the fundamentals, monetary, industrial, geopolitical, are all aligning to drive it forward. What matters now is whether you're positioned for that shift or whether you'll be forced to chase it after it starts. Because once the breakout is underway, it doesn't leave much time for hesitation. When sentiment begins to turn, it usually starts slowly. Quiet upgrades, subtle shifts in language, increased hedging in analyst models. Then, seemingly all at once, consensus begins to align around a new reality. That's what's happening right now with silver. For the past several months, most forecasts have sat cautiously in the mid-$20s to low $30s, reflecting a wait, and see posture from institutions still tethered to outdated assumptions about inflation, growth, and interest rates. But that caution is unraveling. Forecasts are rising, and more importantly, the reasons behind those upward revisions aren't speculative, they're structural. What's driving the change is not a single headline, but the accumulation of data points that no longer support a neutral stance. The supply-demand imbalance has reached a point where it's undeniable. Inventory levels at the London Bullion Market Association and COMEX are at multi-year lows, even as demand from industrial applications and physical investment continues to climb. This isn't just a momentary squeeze, it's the outcome of long-term underinvestment and chronic structural deficit. Analysts who had once brushed this off as cyclical are now revising their models to reflect a sustained shortage extending well into next year. Alongside this, inflation expectations are proving stickier than most central banks anticipated. Even as rates have risen, the feedback loop between energy prices, wage growth, and geopolitical instability is keeping cost pressures elevated. Silver, as both a hedge against monetary debasement and a critical industrial input, stands uniquely positioned to benefit from this hybrid inflationary regime. Analysts are beginning to acknowledge that silver's dual role magnifies its responsiveness to the current macroeconomic environment. As a result, year-end targets are being revised to $38, $42, even as high as $48 in the more aggressive models. Investor behavior is also changing. Exchange-traded products tied to silver are seeing renewed inflows. Coin premiums are widening again, indicating tightening in the physical market. Even institutional mandates, which had largely ignored silver in recent years, are beginning to reallocate as part of a broader diversification strategy amid currency uncertainty and geopolitical stress. This capital flow is not a fluke, it's a signal, and the forecasting community is taking notice. One of the most telling shifts is the change in language used by traditionally conservative research houses. Where previous reports might have framed silver's upside as limited by macro headwinds, the tone has pivoted to phrases like room for breakout, underowned, and momentum building. These are not casual remarks. They're calibrated adjustments that reflect not just a change in outlook, but a change in positioning. Forecasting is often more reactive than predictive, and when consensus begins to lift, it usually signals that positioning has already started to shift under the surface. This isn't about chasing momentum for the sake of it. It's about recognizing when the market narrative is catching up to reality. The models that had kept forecasts conservative are now being revised to include more realistic assumptions about supply tightness, policy stasis, and risk premiums. And because silver is such a small and illiquid market relative to equities or gold, even modest reallocations have outsized impacts. What's most important here is understanding that the consensus is still early. While forecasts are lifting, they are still well below where silver could go in a true supply, led or inflation, protection, driven rally. The upside remains asymmetrical because so few have full exposure. And when consensus starts moving in the right direction but still lags the underlying fundamentals, it creates a gap, one that can be exploited by those who act before the next round of upgrades makes its way into price. That's the environment we're entering now, not one of exuberant speculation, but of reluctant recognition, a market where the math is forcing the hand of forecasters and where the price has begun to move in anticipation of what many are only just beginning to model. So here's the verdict. Over the next 5 months, silver is poised to charge. If one of its major risk triggers, policy shift, recession, flips unexpectedly, we may see a short pullback. But unless that happens, I expect the market to break free from its long technical coil and surge. You are looking at the setup of a lifetime, a strategic investment window rising toward fresh highs. Stay vigilant, stay ready, because when silver moves, it moves fast, and if you're not anchored, you may well be left behind.